We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
Good morning and happy Friday. I'm David Ingles here in Hong Kong. Let's get to your top stories today. Stocks across the Asia-Pacific mixed, and treasuries continue their advance here as traders price in 2 Fed cuts this year. U.S. economic data showing retail sales growth slowing, while you have PPI slumping the most in 5 years. In an exclusive interview, JPMorgan's Jamie Dimon warning that we could still see a recession due to tariff fallout. And Alibaba's growth fails to impress amid a persistent Chinese consumer downturn that could impact the company's pivot towards AI. A very good Friday morning to all of you. Thank you for joining us right now. Amidst, and we've spent, 10 seconds on the shows, at the very top of the shows, outlining all the bad news. Despite and perhaps because of all of that, stocks are actually catching a decent bid. I think we are up now for a 5th week across when you look at the benchmarks in Hong Kong. Certainly when you look at the global benchmark, get this, right? Over the last month or so, we've only had 4 losing days. We're now within about 1.2%, 1.5% to be more, I guess, conventional of hitting a record high. A 10th of 1%, so we're meandering sideways across most equity markets. It has been, of course, as we were just pointing out, really some tailwinds coming through on the back of perhaps some bad news, which we'll get to in a moment. 2 and 10, as you can see, continuing to drop here in the Asia-Pacific. And as you can see, we now have a 3 handle on the 2-year yield. Gold is catching a bid as we speak. Let's have a look at how we did overnight. So, I mean, when you look at the China market story, it's really been a week of earnings, liquidity. We'll get to the Hong Kong dollar in a moment. But certainly one stock we'll be tracking very closely, which I imagine will already see some downside signals in the next few minutes or so. Alibaba down 7.5% following rather disappointing earnings when you look at sales, missing estimates there. Yes, you did get a pop in things like net income, for example. That was down to other things apart from the core business. NetEase is also one stock we'll be tracking, as well as GD, on the back of also, in this case, decent earnings and, of course, also a shakeup as far as leadership is concerned on the Geely story. Right. A50 futures coming online. As you can see, we're seeing a bit of weakness right now. Still, though, we are set, given the declines we're seeing, still set to sort of hurdle the week for a weekly gain. Dollar China and dollar Hong Kong, 780. But the story on the dollar Hong Kong story is really when you look at forwards, right? Still straying well beyond the strong end of the allowed range. What does that tell you? How do you bet on that? How do you trade on that? In any case, HIBOR, of course, has been pushing towards lows, and we'll see whether or not that does continue into the Friday session. Just to note, UBS, one of the latest there to raise their targets for the benchmarks in China from 73, Avril. They now have an 80 projection on MSCI China. Avril.
Yeah, and we're on track for a 4th weekly gain on MSCI China. But, you know, it's going to be that digestion of earnings. Alibaba, as you know, is often seen as this barometer, right, of the Chinese economy. So does this indicate the need for more stimulus? Gaming companies, they've been faring pretty well this week. Think about Tencent, think about NetEase, right? We're also watching out for the Hang Seng Indices review, whether that reflects a bit more this urge for a consumption-driven economy, more supply coming online as well when it comes to Chinese government bonds, keeping an eye on that APEC trade ministers meeting in Jeju, whether there are further interactions when it comes to the US and the Chinese trade envoys, and as you mentioned, those Hong Kong dollar forwards. Plenty to watch this Friday. David.
Yeah, well, let's get to the comments here out of the JPMorgan boss, Jamie Dimon, really, in terms of just the macro context. Certainly, we've seen the data come in very soft. We'll get to that in a moment. But certainly the backdrop really here is that the U.S., he says, could still slip into a recession despite the easing of these trade tensions with Beijing. He spoke exclusively with Bloomberg at the bank's Global Markets Conference in Paris.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
Yeah, the comments there and the projections and his outlook for the economy, and certainly when you look at all the data that's come through, most of it, to be more specific, particularly overnight, does suggest and offer further signs here of slowing economic activity, certainly dimming inflation, supporting the markets that are moving and coalescing towards currently now a full cut price for September in rates markets. Jill Deeses is with us right now, our news desk editor, to talk us through the data we've seen so far and just the signs of softness that have started to emerge.
Yeah, I think particularly those producer prices falling by the most, was it 5 years?
Yep.
So, I mean, I think at this point, I mean, that was unexpected, but what that does indicate to us at this point is that when it comes to the impact of the tariffs, a lot of companies, at least right now, are holding off on passing those costs on to consumers. Of course, you know, I wouldn't expect that to last forever. We were speaking with some economists overnight who were warning that, for example, when tariffs on washing machines back in, I think it was 2018, were put into effect, it actually took about 3 months or so before those costs started transmitting to the consumer. But I think what you're seeing here, at least from this data, is that it does indicate that companies right now are really worried about that eventual passing on of those prices. We saw Walmart say during earnings, for example, that they were expecting price increases down the line. And right now, I mean, particularly when you combine this with that fairly soft retail sales data, that does suggest that after stockpiling a bit, right when those tariffs were announced, consumers are now becoming a little bit more cautious, and companies are really wary about raising prices right now. They're going to try to mitigate that as much as they possibly can. Obviously, we've had some relief recently, the US-China trade agreement for now, but again, that's only 90 days. We still have some other trade deals that need to come into effect. So it does point to an environment of a lot of uncertainty right now, and certainly a lot of concern over softening consumer appetite.
Right. Jill, thank you so much. Wrapping up the soft retail sales and also the producer prices there. Avril, and just this goes into, Avril, the Fed conversation. How many cuts will we see? Will that come in earlier? And what does this mean really for the broader weakness we're seeing, Avril, in the U.S. dollar?
Absolutely. I mean, we've been seeing, David, the start of this week, it was a picture of that US-China trade truce along with signs of US economic resilience, right? But fast forward to today, and the picture of the US economy is really quite different. So let's bring in Francis Cheung, head of FX and rate strategy at OCBC Bank, for a discussion, more analysis on what lies ahead for the Federal Reserve. What do you think we're going to get out of the Fed? Because, you know, the expectations keep changing.
Yeah, so the Fed still appears that they are in no hurry to cut interest rates. The primary reason is that they see a lot of uncertainty on both the inflation and the growth outlook, including the impact from the tariffs. So now we do have kind of a benign inflation backdrop, as suggested by the latest CPI and PPI. But because I think the Fed would like to have a couple more months of data to give them the green light to cut interest rates. And we do think that the trigger for the next interest rate cut would likely need to come from the labor market, or i.e. the growth front, right? So we look at the different labor market indicators. They do suggest that the labor market continue to cool in a very gradual manner. So the problem is that the cooling is really a very slow process. That means that the Fed is, again, in no hurry. And we do continue to expect room for up to actually 3 Fed fund rate cut for the rest of the year. But the problem is that, or the risk is that they may further delay the rate cuts to the later part of the year. But having said that, the market has already kind of pared back rate cut expectation compared to 1-2 months ago, when it was around 100 basis points of cuts being priced. This morning, around 55 basis points. So that might mean that the short-term Treasury yields could stay at the current level quite comfortably.
On the Fed's part, Francis, you've kind of pushed back your expectations along with the markets on when we see the cut this year. Does it mean that the Fed is going to go slow and then have to rush towards the end of the year? Is there a risk that, again, it will be too late in reacting?
Yeah, we do highlight two risks to our base case. One is the timing of the cut. The other is actually the pace of the cut. So yes, if they kind of delay the rate cut to the later part of the year, we now expect the next cut in Q3. But if they further delay that, then we cannot rule out that they might need to really play some catch up and even do a bigger size of rate cuts, right? So it might be a repetition of last year, which is what happening. And if you look at the labor market indicator again, if we go back to that, they always like to cite this so-called Beveridge curve, which you plot the job vacancy versus the unemployment rate, and that actually was very helpful in gauging the timing of the rate cuts last year. And now we are also moving along this line, suggesting the labor market is cooling. But just that, again, because of all the uncertainties, and the Fed is highly data dependent, but by default data are a bit lagging. That means that by the time when they see the data further cooling or like further slowdown in the US economy, it might be a little bit behind the curve already.
Francis, David here, and I think that's a very good really entry point to zoom out. And I want to get your thoughts on the role reversal that we've perceived so far in the US dollar. It's behaving more like a risk asset than it is a defensive one. Do you think that's the right conclusion to make right now on the dollar?
I think in the longer term, or like after this current period of like kind of some market jitteries, because the focus of the tariff is on the US economy growth itself, in the next few periods, the dollar may behave back like a safe haven. So for example, if there is some further de-escalation in tariff or the trade front, then the overall global growth would also face a little bit less downside. Then that might actually give a little bit more strength back to the dollar. But that is kind of on a multi-month horizon. However, riding on this theme of asset allocation, right, away from the dollar assets, I guess at this part of the world, for a lot of the domestic investors, there is the strategy to play. That is to kind of repatriate some of your dollar assets back to the domestic market, or because they may not be able to repatriate a lot due to the limited supply of domestic market investable products, then these domestic investors in various regions would also need to increase their hedge ratio, right? So either you repatriate from your dollar assets or you increase your hedge ratio, or these would actually add to appreciation pressure of Asian currencies, i.e. would add to some softness in the dollar. That is kind of the longer term trajectory.
Yeah, and I think there's no better example of what you just outlined there than what we've seen in the Taiwan dollar, right? And I wonder, do you think the next few months will, to your point, see structurally costlier hedges because of this shift that's taking place, Francis?
Yeah, indeed. So just now we mentioned the strategy, so that can apply across Asian markets. But speaking of the Taiwan dollar markets, because due to some specific characteristic in their insurance sector, so there is a mechanism, which is the FX volatility reserve mechanism, which has been designed to kind of smooth out the P&L of the lifers, right? So you have this reserve where you can add to or where you can take out, depending on your FX gains or losses. So that actually means that over the past few years, the hedging ratios among these lifers are actually not particularly high. So from that starting point, there might have been a little bit more to play catch up from the Taiwan dollar's perspective compared to some other Asian currencies. And then when all these other market participants, I see dollar, Taiwan dollar kind of at a lower level, they might also have that incentive to rush to sell some dollars, for example, for the exporters to sell the dollars, etc. So that is kind of a self-fulfilling cycle, which may help explain the slightly bigger move in dollar Taiwan compared to some other Asian currencies. That all being said, hopefully by now the hedging ratio has already been increased somewhat, and that would also mean that any downward move in dollar Taiwan might not be at that pace, that rapid pace that we have been seeing over the past few weeks.
Right, so the gains in TWD maybe topped off a little. Francis, stick around. We have a lot more to discuss with you. Francis Cheung of OCBC Bank. David? Yeah,
in fact, we're still watching these trade talks, and a lot of what happens in these negotiations will determine the fate, certainly, of the trades that Francis just outlined there. And, you know, when you look between the U.S. and China, what's taking place there, you have the Vice Commerce Minister in China, Li Chenggang, telling Bloomberg that he actually had good talks with the U.S. Trade Representative, Jameson Greer, at the APEC meeting taking place in South Korea. And the two actually met less than a week after both sides agreed on a temporary pause in tariffs. Have a look.
Minister Lee, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
There we go. Yeah, quick and back and forth. In fact, our chief North Asia correspondent, Stephen Engel, also tried to get the comments from Jameson Greer at that meeting in South Korea, but the U.S. official, as you're seeing there, effectively just kept mum. Right. Counting down to the open of trade. The Friday session is, 15 minutes away. We're looking at Alibaba. I'm looking at my screens right now. We are called lower, indicated lower on shares of Alibaba. I'm seeing 120 price signal now on my screens. Reference rate of the day is out as well, 719.38 against the US dollar. There is plenty on the plate this Friday. This is the China Show.
You're watching the China Show, and as we just told you, we're seeing a stronger yuan fix from the PBOC today. Still with us is Francis Cheung, head of FX and rate strategy at OCBC Bank. Francis, what are your thoughts on the signals we've been getting from the PBOC on the yuan this week? And to what extent do you think the currency can actually benefit from this trade truce?
Now, actually, if you look at all the past renminbi fixings, right, you will notice that PBOC always have adopted a measured approach to the fixing in either direction, so whether there is upside or downward pressure on dollar CNY. So just as during the previous period, when they tried to resist the upward pressure on dollar renminbi, so looking ahead, if opportunity emerge, for example, against a soft dollar backdrop when other Asian currencies are also appreciating, PBOC may also likely to adopt a measured approach to allow for very gradual renminbi appreciation. So the bottom line is that sharp move is always undesirable in either direction. So sharp renminbi depreciation would lead to vicious cycle of outflows and further pressure on the spot. And sharp renminbi appreciation will hurt export and also add to renminbi stability or volatility. So from that perspective, the line to take is always stability around a certain anchor level, although this anchor level can shift over time. For now, we do think that there would be some two-way range trading around the 720 levels.
What about Hong Kong dollar, Francis? I mean, it's among the currencies that have strengthened. We've seen some form of intervention in defense of the ban. How should we be thinking about this?
Yeah, because of the currency support system, the US dollar, Hong Kong dollar peg, then of course spot cannot be really go below the 775 level. So as a result of the earlier FX intervention by the Hong Kong MA, the mechanism has said that there have been liquidity injected into the Hong Kong interbank system, right? So you have been seeing high balls fixing very low, Hong Kong dollar interest rates very low, and then alongside the forward points also fell. So I understand that there is a lot of focus on the forward outright because the forward outright level is actually below the strong side convertibility undertaking, which means that it is actually broken the peg. But however, if we take a step back, right, the outright is simply a reflection of the interest rate differentials. So if you have Hong Kong dollar interest rates very much below US dollar interest rates, then by right, Hong Kong dollar has to appreciate in the forward market. So when we we try to compare forward outright, the forward points, and also interest rates differential, we do not see too much of a dislocation there. So the situation may continue as such, and Hong Kong dollar liquidity is still quite flush. Although now we have spot moving away from 775, which means that the risk of near-term Hong Kong MA intervention is already very much reduced. But let's not forget that the liquidity that was earlier injected would stay in the system unless there is FX intervention in the opposite direction, whereas Hong Kong dollar honky at 785, or unless Hong Kong MA proactively move liquidity to bills. But from what they have been saying, it seems that they are comfortable to see dollar rates, Hong Kong dollar rates lower.
Francis, as always, it's nice to talk to you. Have a good weekend ahead, and thank you for the insights there. Francis Cheung, head of FX and rate strategy, and to the point there, we're looking at Hong Kong dollar forwards. That's rare we do that, but certainly when you look at how far they've strayed from the norm, it's understandable to focus there. Right, the other focus is also now in Alibaba. We're about 2 minutes into the pre-market session. We're down 6%. That's an earnings story. The opposite side is NetEase. We're up 11%. We'll talk more about those stocks in a moment. We'll take a short break. On the other side of this, we'll unpack the Baba earnings coming through. 7 minutes away the opening bell. This is the China Show. Happy Friday. Good morning. Welcome to the show. Right, lots of specific names to watch here. We'll start things off with the big one in the room here. Baba down overnight, down going into the Friday session here. We'll unpack the numbers, but suffice to say, on the revenue side, slightly missing. The net income side, I think multiples higher, but that was really down to other things. Markets are reacting negatively, but it's worth pointing out this is really one of the best performing stocks in the greater China universe this year. It's up 60%. Going into today, it's still up about 55, 56 right now, even with the drop that we're seeing today. So there is some temptation to take some money off the table, given the rather lackluster earnings coming through there out of the company. It's worth also pointing out, though, from the greater, with the greater scheme of things considered, most of the tech space have reported decent sets. You have Tencent. NetEase is a very good example of that going into sort of gaming conversations. 10.9% to the upside, beating estimates as far as that's concerned. And Geely, of course, also out with some earnings, plus a rejigging, some changes there as far as management is concerned. Okay, other things we're tracking today. So we are on track for a 5th week of gains on Hong Kong benchmarks. We'll see, though. We'll see, right? Because there is a chance that we get a pull from Baba, and that takes us back behind the line of where we would be compared to Friday close of last week. Right. We also have on deck today the results of the quarterly review out of the Hang Seng indexes. And, yeah, PopMart, Beijing are likely to be included. That's according to the founder of Periscope Analytics, who publishes, of course, on Smart Comma, that note there that those are the candidates. In the early goings, we're looking at declines here going into the Friday session in the order of about 1%. The opening bell is coming up next. Good morning. So on screen, I can tell you it's actually looking immaculate out there, the weather. On the ground, though, it kind of feels like a couple of levels below the surface. So humidity is back, the heat is back. It's like you're walking straight into a wall of sweat. Something, of course, folks in Southeast Asia and in Singapore are used to. We're not used to that, though, here in Hong Kong, Avril, because, we do get this every now and then, maybe parts of the year, not all the year, the entirety of the year that you guys are used to in Singapore, which I guess is a good thing. But yeah, we're not used to this, so I'm gonna hide on the weekend, and I'll see you all on Monday.
I mean, yeah, to your point, I think it's very stable when it comes to Singapore, not just on the weather, right? A lot of other things as well. But let's check in on the open when it comes to mainland stocks. I mean, yeah, we're seeing a bit of a softness emerging. We're seeing some banks looking a bit softer as well, even though financials, I think, on the CSI 300 have more or less been outperforming for much of this month. Of course, the trade talks are going to be in focus. Whatever comes through between the US and China, does this affect any of the stimulus odds? Flip the board and take a look at how Hong Kong is shaping up. Of course, it's that earnings read-through, but we are also keeping track on the MSCI China. These declines 1% at the start. This is an index that's on track, though, for a fourth weekly gain, I believe. Not sure if this this early goings changes the picture, but certainly, as I said, it's about the earnings, right? And we didn't quite get the hat trick we wanted after JD, after Tencent. Alibaba kind of pulled the mood down, so 6% lower. Although for gaming companies, for much of this week, it's been looking pretty upbeat. NetEase, in terms of that massive beat, although Bloomberg Intelligence sees this as more of a one-off, not sustainable. Geely also looking flat, even though it beat by quite a fair bit, David. So really, this earnings story that's coming through.
Yeah, and we really got to take a step back now, right? Because we have most of the big ones that have come out. I think we still have a couple of more going into next week. But yeah, we've had Tencent this week. We've had really a sense of the gaming, NetEase, to your point, and then of course we had the Alibaba story, which I think when you look at it, really more an exception to what most have given us. But I guess have expectations also been driven a little bit too high for Alibaba, given the fact that the shares were up 60% before the Friday session today. Right, so we did have a slight disappointment on Alibaba. In fact, let's get more on the Baba earnings story, and let's bring in Claire Chia. She's here with us, of course, our tech reporter, to tell us and give us a general recap of the earnings. Yeah, good morning. So,
morning, David.
How do you think they went?
Yeah, Alibaba's results last night were really discouraging to the market. So they posted a quarterly revenue was 236.5 billion yuan.
Okay.
That's a disappointing 7% growth, slightly below estimates. So looking at the breakdown, so the core domestic e-commerce business beat expectation by growing 9%, thanks to supportive measures by Beijing to help counter US tariffs. But the Ali Cloud business, which is really in the spotlight of investors, missed projections. China is the only division that posted decline in revenue, down 12% from the previous quarter. And beyond China, the international commerce division grew 22% in revenue, but that's also slower than expected. So the overall miss kind of stood out after its rivals Tencent and JD really post strong momentum earlier this week. So we saw JD sales up by 16% and Tencent up by 13%. So if we say Tencent presented an image of steady and consistent growth, Alibaba has a more complicated story to tell.
Yeah, but maybe there is more on the outlook. You talked about cloud, and of course e-commerce also comes to mind. Could you talk about cloud and e-commerce as well, and the outlook for both?
Yeah, so the key cloud division didn't really outperform as many investors had hoped, although the AI revenue continued a strong run of triple-digit growth. Ant Group's quarterly profit fell 31%, and the major reason of the loss goes to its investment in artificial intelligence and other initiatives to bolster revenue growth. Alibaba has been really aggressive in the white-hot AI race since the start of this year, when DeepSeek emerged. And last month they unveiled a new version of its flagship Q1 AI model, and just this Wednesday they updated their video generating model.
Yeah, the video one.
Yeah, so that's the second time they did it in the past month. But investors worry that Trump administration's curbs of sale of NVIDIA's chips to China is also another worry for investors. But in the earnings call last night, we heard Eddie Wu reiterating, the CEO Eddie Wu reiterating that the company is seeing a huge surging demand in AI chips in the past month, and he expects more to come.
Okay. Yeah, and I think this, Avril, can I bring you in here, because this really begs the question whether the Alibaba story is an exception, or maybe what does this tell us about the tech comeback, Avril?
Yeah, I mean, we were waiting out for this hat trick, right? But certainly it looks like a bit of a disappointment on the Alibaba front. wondering, of course, whether or not this kind of fuels or becomes a bit of a distraction to the Chinese tech rally that we've been seeing of late. And Baba, worth noting, this is a stock that has climbed, I think, almost 60% this year, right? So actually the pullback that we're seeing in the US, in Hong Kong trade, maybe not as bad given how far the shares have run up. But yeah, Claire, just wondering if you could weigh in on this for us. What does this mean overall for the Chinese tech comeback?
Yeah, we see Alibaba as the last tech giant to post earnings this week. So we saw very strong momentum from Tencent and JD earlier this week. Alibaba shares still up around 60% this year. We see Tencent up almost 25% and Xiaomi up 40%. So investors were really looking at a China tech comeback. But there are still concerns. So we have the unpredictable US-China tariffs, and also investors worry about the US chip sale curb to China. So there are still challenges for foreign capital to actually come back to the China tech market.
Yeah, especially at these levels, to Claire's point, right? A lot of these stocks, and I think the point there too was, a lot of these stocks have really done well. And the earnings have been decent, not spectacular, not blockbuster, but decent, and you had some weak spots here and there. But to get to the point, right, we'll really have to see how investors really feel about this, particularly, again, given the fact that this is a group of shares that, we're not normally used to seeing gains like this. 20% is an underperformer, 50% is more really the norm. Claire, fantastic work there, of course. Just wrapping up the Baba story for us and really the big picture context as far as tech is concerned. Right, the other story we're tracking at this point in time, and wow, first day at school, 110%. Zerun is an IPO, mainland listing here. It's a company that distributes and, makes industrial electronics. And suffice to say, it's a happy Friday. He got into this one as well. We'll see what the secondary market looks like in the next couple of minutes or so. But yeah, apart from that, I think Avril's a big fan of Labubu and Pop Mart.
Speak for yourself, David. Maybe as an investor, not so much of the product maybe. Don't want to be giving any of this investment advice, but yeah, to your point, I think it's really this backdrop that we've been seeing. Pop Mart, that's something that's been very interesting. Healthcare giant Beijing, Prada. These are among the companies that may be included in the Hang Seng Index. And of course, we're expecting this quarterly review of the index later. Bloomberg senior Asia equities reporter Abhishek Vishnoi joins us now for a chat. So Abhi, just getting your thoughts, what does this tell us about maybe the way in which the index or the indices is trying to reflect a more consumption-driven economy? What does this tell us?
I mean, it means that there is a concerted effort, right, from market participants to government stimulus and other measures that China is trying to go in the direction of being driven more by local consumption. And that is what is getting reflected. But, among the candidates that are being talked about, I think Pop Mart has a very decent chance of being included. The stock has almost doubled. Beijing, I'm not so sure about because the stock has been falling. In this rebound that we have seen over this week, I think Beijing was among one of the top losers that HSAI had. So Pop Mart definitely is on the cards. And its addition also shows that, the new generation's spending habits, spending patterns have started getting reflected into the index. There is more spending happening on, these affordable, well-priced items, which are like a big-ticket item divided into small pieces of royalties and then being sold off, versus names like Moutai, which peaked in 2021. So it's a turn, but more needs to happen. Just, this kind of spending would not be enough for China to come out of its troubles. You need all generations to come in. And remember, China, was best known as factory of the world. If that role is not sufficing, it needs to quickly transform into one that is driven where economy is driven by local consumption. So either this or that, but it needs to happen in a big way. And everything needs to participate.
Everything needs to participate, and we're also seeing these shifts in spending patterns among the youth, right? What are you seeing, and how is that perhaps reflected in investment as well.
That's right. I mean, there is spending a pattern of Gen Z that is getting reflected in the index. That's why PopMart has rallied this much, and it's going to come into the index. We are also seeing similar bets being made in, some jewelry makers. We are also seeing similar bets being made in some recent coffee makers which have gotten listed over the last 1 year. But what I've seen, I mean, if you compare it with advanced markets, if you compare these trends with what has happened in China in the past, coffee makers are a trade. Gold and jewelry stocks are here to stay. I mean, it's actually a partial bet on gold, not just jewelry, right? And we have seen this story resonating not just in China but in India, US, and other parts of the world as well. On PopMart, I mean, it's really, how MS has put it. Morgan Stanley recently came out with a note that the stock is on its path to become a combination of Lego, a combination of Bandai Namco, so gaming, movies, and all such things put together. And it shows that how new generation is spending more on what they perceive, is affordable in their context and is good for their mind and their body, right, rather than spending on high-priced Maotang.
Oh yeah, let me drop some Latin there. Good for the mind and good for the body, right? Mensana and corpore sano. On the note you were just pointing out, the fusion that PopMart represents, right? And I think we were having this conversation earlier yesterday, Abby, with some of our producers here, and we were trying to figure out, on the Baba story, one of the best performing stocks in the greater China region. The top is actually, well, near the top is Chow Tai Fook. I think to your point, jewelry, gold have really been big winners in this trade. So I guess, but the question I want to get to is, now that we're almost done with earnings season, now that this gold trade looks to have run at least its course for now, we'll see, right? We don't know. But so what's next? What's next for the greater Chinese market? What will be the drivers to this equity market moving forward?
I think, if you look at the setup, this week was really good. It's been the best week in last 6 or something, or 5th straight week of gains, and it's the best week since March that we have seen on HSCI, MSCI. All other indexes have, risen 1.5% to 2% to 3% each over this period. Now, the trading, trade war tensions have eased. The setup is looking good. It's looking more like, a pre-trade war. But it's definitely not, it's looking more like pre-trade war, but not like pre-COVID. So, strategists are excited, locals are excited, but global money is still very cagey. Global money is not as confident as it used to be before COVID times. So, it's like a glass half empty, half full kind of narrative. And on earnings, David, again, Morgan Stanley came out with an analysis recently, and, our team is working on a very nice story, which will put everything in context. But at this point in time, earnings are in line with expectations, and that's happening after a string of quarters. So, I would take it positively that, earnings are in line after a long line of disappointment. So, put together, there is excitement about sell side. Earnings are coming in, trade war tensions dial back, valuations go up. It looks really good. If you look at the members which have been contributing, it's internet, and banks. So, internet represents growth, tech, not value. Banks represent value, yield. So just from a yield cheap bet, China is emerging to what it used to be in the DeepSeek afterglow once again. But more needs to be done, definitely, and more steps need to be taken in terms of stimulus. And the verdict is yet to be out on trade war. I mean, tariffs are still increasing. That means essentially supply chains would get reformed again, and therefore marginally it's going to be negative for China, which is well established as factory of the world. So we need to see how things pan out from here, and more convincing is needed for global money to come in. But net, I feel it's a very positive setup for China.
That's really important context, Abi. Thank you so much for coming in, weighing in. Certainly we'll be following the money and the spending patterns for time to come. Bloomberg senior Asia equities reporter Abhishek Vishnoi. Plenty more ahead. This is Bloomberg.
Welcome back. Now, in case you missed it, let's get into really one of the most read stories over the last, let's call it 12, 18 hours or so. You're looking at shares of Coinbase. I mean, as you can see, down substantially. That's after the company disclosed a hack that actually put customer data, including banking information at risk. And according to reports, that the company is also under investigation by the SEC for misstating user numbers. Let's bring in our tech correspondent, Annabelle Jeweler. She's with us out of Taipei for more on the story. So, Belle, I mean, I guess in context, and I guess for nuance here, it's certainly not the most we've seen taken in a crypto heist, but for a number of reasons, this one stands out.
Yeah, that's right. I mean, I think when you talk about the numerical value of this, it's around $400 million. So that sort of becomes maybe around the 8th most consequential that we've seen in the crypto industry to date. But the company in question is really consequential because Coinbase is the company, perhaps you could say, really intersects the crypto industry and Wall Street best. It was the first ever listed crypto exchange. It's also the company that safeguards the tokens that are held on behalf of the spot crypto ETFs in the US, rather. And it's also the firm that's really been out in front the most, lobbying Washington for more business-friendly crypto regulations. So this is really significant on that basis. Also, the timing of it, it's very, I guess you could say, at least inconvenient for the business, not just because it's been recently added to the S&P 500 index. Again, another testament to the significance of the business. But yes, $400 million, that's the cost of this. Part of this was a $20 million ransom that the hackers have demanded. Coinbase is saying they're not going to be paying that. Instead, they're going to be using those funds to put forward to try and find out more information to hold these hackers accountable.
And Belle, how exactly did these hackers pull it off?
It's certainly brazen, Avril, but it's not really the most technologically savvy hack that we've ever seen either. So what we understand is that these hackers, they bribed customer representatives in India, so they paid these customer representatives money, and then through that they were able to obtain access to different user account data, so things like names, date of birth, government ID figures, bank accounts, details about when the accounts were established, how much is being held in those, and then the hackers use that information to then go to Coinbase customers, impersonate Coinbase to gain access as well. It's important because it's not just, of course, a really big invasion of users' privacy, but there are also other impacts. This year, for instance, we've seen at least one kidnapping that actually ended up leading to a mutilation of that individual as well. And so there's really big safety concerns that come to the fore because there are reports of other kidnappings as well. So if you're a very high profile or a big user of Coinbase, I mean, a lot of people would have reason or grounds to be feeling quite vulnerable today.
Vel, just briefly before we let you go, what do we know about these reports of this investigation from the SEC into the company?
Yeah, so this is actually New York Times reporting, but they're saying that there's an investigation ongoing as to whether Coinbase misstated user account or user account figures, activity figures. And so this is their reporting. The Coinbase chief legal officer has responded to this, saying that essentially it's very baseless. It's something that was instigated under the Biden era administration, and they're actually working with officials as well to have this removed. And they're saying that they're remaining committed to working with the SEC. They're also saying these user metrics in question, they actually haven't been reporting them for quite a period now, going back around 2.5 years.
Belle, great reporting. Thanks so much. Annabelle Jeweler in Taipei for us. Playing more ahead, this is Bloomberg. You're watching The China Show, and to other corporate stories we're following. We're watching stocks of NetEase after the Chinese firm reported sales and earnings that beat estimates. Revenue for the first quarter came in at $4 billion, boosted by its core gaming business. NetEase's quarterly gross profit was $2.57 billion, beating the street. Geely's shares also in focus after the firm reported first quarter net income that arrived at the high end of preliminary results. Net income was $786 million, with revenue up 25% on year, coming in at $10 billion. Meanwhile, the company says Zeekr CEO Andy An will become the group CEO after Zeekr's privatization by Geely Auto is complete. CATL's Hong Kong listing has been fully upsized to 135.6 million shares, not including the over-allotment option. The company sold 117.9 million shares in the base offering and exercised the offer size adjustment option of 17.7 million shares. David.
Yeah, we'll just take it straight now to some live pictures. This is out of Taipei, and these are some protesters gathered. Should be outside Parliament. And the protest, I'm just trying to read this as well. Okay, effectively, it seems to be against the government's plans to implement a zero tariff policy on American products. And we do understand that the Taiwanese premier is actually set to have a briefing in a couple of minutes here. To effectively, we'll see what he says on that as well. And just to mention that as well, so coming up in the next hour, Taiwan will feature quite favorably and into our coverage right now, because we will be joined by the new AmCham, head of AmCham Taiwan, joining us in the second hour of the program. So we'll keep on top of the story as these negotiations are currently taking place and progressing on many fronts with the United States. There's also an earnings story. We'll recap all of that, as Avril was pointing out, some big moves we're seeing in the equity market. Overall, though, bad news seems to be good news for the equity markets. We're very close to hitting a record high. More on that in a moment. This is the China Show. Welcome back. You're watching The China Show. We're just going into the second hour of the program. We're about 30 minutes into the cash market session. Thereabouts, well, if you want to be pedantic about it, we're about 29 minutes and going on 30 seconds into the cash market session. A couple of things on the table today as far as Hong Kong is concerned. Certainly when you look at markets, fifth week of gains, there's an earnings reaction. We'll get to that in a moment. There's an index review. Might we see some changes out of the index compiler later today? GDP numbers are coming out, in fact, at about the same time. Separately, certainly, from that index review, at about the same time. Final numbers are coming through, and of course, for the current geeks out there, forward points, something we don't normally talk about on the Hong Kong dollars. I mean, Hong Kong dollars is not something we talk about normally to begin with. Forward points continue to stress, I think, the point and the narrative here that might it be time to fade that as well. So you have forward points actually now straying well beyond the strong end of the trading band. On the earnings story, we won't go into the details here, but as you can see coming up on your screen shortly, with NetEase at least, Geely and Alibaba, the story there is quite self-explanatory, if you will. NetEase, good earnings, Geely as well. Alibaba, disappointing markets, although it's worth pointing out we're coming off lows of the day there on shares of Baba. Chow Tai, if I could just have that in there as well, just given the fact that this is really one of the best performing stocks this year to date, and it's continuing its run up about 2% first 30 minutes of trade. Right. The other story too is, apart from this, we're looking at global equity markets are pulling back a little bit. Although I think here's a funny statistic. In fact, flip the boards, please. And as we look at that, and as I tell you that, right, you look at the 2- and 10-year yield. We're coming off there for a second straight day. Here's a statistic for you. Bad news is good news? Question mark. And over the last month, the MSCI All Country Index has only had, I think, 3 or 4 at most, 4 losing days, despite all the uncertainty and the changing of the parameters out there. And we're now just within a 1 or 2 good days away from hitting a new high that we hit, I think, back on Feb 18 of this year on the global benchmark. So it's a really good setup, Avril, going into the weekend.
Yeah, maybe bad news is good news again. So let's bring in our Bloomberg M Life strategist, Mary Nicola, to talk us through how we should be maybe thinking about all this. Mary, as David was just dissecting there, highlighting what we're seeing in terms of Chinese tech earnings, but also the data that we're watching out of the US, and we're ending the week, it's looking a bit of a softer picture from the world's largest economy. I mean, we're seeing the move in treasuries as well. How are you thinking about all this? What stands out to you?
I think the main thing that stands out is the fact that we're going to see further dollar downside, and where you see upward pressure on Asian currencies in particular. So you're getting a little bit more headway, even if it's at a very slow pace, but you're still seeing progress on appreciation from the Chinese yuan. And then, of course, you've got a favorable environment with lower oil prices, lower U.S. Treasury yields. That all bodes well for Asian currencies. And I think that trend in terms of shifting away from the dollar is going to continue, especially with some of these added tailwinds in the mix.
Mary, I think on the note you were just pointing out there, it's clear, I think, disinflation, at least in many parts of the world, excluding the U.S., is fairly clear. And you've had quite a nice piece that this does open up the opportunity for EM and local currency debt. If you could just outline the thesis for us and what this means for investment strategy.
Yeah, absolutely. One of the key things that that has been striking is the fact that, if you look at duration is going, especially in local currency bonds, it's going to be a winner. And one of the reasons why is because you are seeing disinflationary pressures globally, but of course, as you highlighted, just not in the US. So one of the reasons is that we're seeing that the fact that China's inflation is decelerating and we're in deflationary territory, and PPI in China remains exceptionally weak. That's also translating into China exporting deflation elsewhere. So, and you're hearing comments from authorities from Thailand and of course we had a big take a while ago about how textile companies are shutting down because of the influx of Chinese orders, because at the end of the day, a lot of these Chinese exports need to find a home somewhere, and demand is quite weak still in China. So I think what you're going to see is ongoing disinflationary pressures across Asia, but that opens the way for more cuts from the central bank. But key to a lot of the central banks that they're going to need the cuts is the fact that the currency is stabilizing. So let's look at over the past month, a lot of the Asian currencies have actually appreciated against the dollar. So that gives them a lot of headway to continue with easing without over concern about excess currency volatility, which of course that's been one of the key reasons. For example, the Bank of Indonesia has held back, and same thing with Bank of Korea. But now with a little bit more oomph behind a lot of these Asian currencies, they can be a little bit more able to focus on both inflation and the disinflationary pressures and growth.
Fantastic, Mary. Thank you for framing all of that for us. Bloomberg's MLife strategist, Mary Nicola. Let's bring in Navin Saigal, head of fundamental fixed income Asia Pacific at BlackRock. So, Navin, as we've just been hearing from Mary, this disinflation trend outside of the US, from China maybe to other parts of EM Asia. Would you agree that's how we should be thinking about things?
So first of all, thanks for having me on the show, and I completely agree. I think the current environment is an exciting one. It's one that I think most investors are perhaps not entirely used to, but it's one of divergence and desynchronization amongst the major economies on either side of the Pacific. I think this is a structural trend that started perhaps up to a decade ago, but I think it's really been accelerated by COVID and now the current geopolitical framework and the policy uncertainty around trade. I think what we're doing is basically maybe not jamming on the brakes of globalization, but certainly tapping on the brakes. And that has huge and profound impacts for countries on either side of the Pacific. So the epicenter of this is the Pacific Ocean, US on one side, China on the other. But I think what is inflationary at the margin for the US could be deflationary for China and the rest of Asia, simply because there is too much manufacturing capacity in Asia for the Asian domestic market to absorb. So I think this disinflationary or deflationary trend is real. but I think it creates a huge opportunity for bond investors, for fixed income investors, to add a diversified market, an uncorrelated market to their global portfolio. Today, that global portfolio is extremely attractive. You can get about a 7% yield in a global, fairly safe portfolio, investment grade, without taking a lot of duration risk or spread risk. This portfolio can include a bunch of Asian bonds for this exact reason.
Specific where in Asia, you think?
Well, I think any country that is not priced for a lot of cuts, for a shallow easing cycle, is one that's pretty attractive, given that a disinflationary or deflationary impulse tends to create room for the central bank to cut more. So, for example, Malaysia, not really priced for cuts, India, pretty benign cycle, even Australia. I think it's the whole of the Asia-Pacific region, honestly, is quite attractive from a duration standpoint at a time when the US market, I would say, is facing some challenges when it comes to duration at the long end of the Treasury yield curve.
Navin, David here. Is there room right now for hard currency bonds in one's portfolio, or is it, I think to your point, mostly just an EM local currency story for now? Just to help us understand that sort of seesaw there between those two things.
There's definitely room for hard currency bonds, but I think the real opportunity is, as you mentioned, David, in the local currency space. The only challenge, so fundamentally, this all makes sense. In theory, this all makes sense. But the only challenge is that the size of the local currency market is still quite small at the moment. So I think investors are struggling with this tension, right, where they want to diversify their portfolio into local currency, but the sizes are really comparable to US corporate segments. For example, I would say even some of the bigger markets like UK and Germany are about the size of the single A and triple B US IG corporate markets. Singapore, where I am right now, is about half the size of the US CMBS market. And so you have a bit of a challenge there, but that's where we're here to help, to build a diversified portfolio, a broad portfolio of the 40-odd countries that make up APEC. That's another thing. Right? People talk about the US and APEC as entities, but one is one country and the other is about 40 countries. I think if you group all the countries together, you start to be able to construct a portfolio. It does take a few more building blocks, but the opportunity is a big one and should be looked at.
And Navin, one vector that you haven't touched upon, and if you could maybe outline this a bit further, is you mentioned you don't have to take too much risk at this point, give up too much quality to get the yield of about 7%. High yield, though, has done exceptionally well in the last few weeks or so. How are you thinking about high yield at this point?
So I think there's definitely room for high yield in the portfolio. I just don't think it has to be the majority of a portfolio because you don't have to make it the majority of the portfolio in order to hit those high overall yields. I think at a time like this, when there's a lot of policy uncertainty that is driving inflation uncertainty, spread risk arguably is the more palatable risk to duration risk. I think there's not enough term premium in the yield curve in the US. When the 10-year note is yielding about the same as cash, one might argue, you should have more compensation for owning the long end of the yield curve. But high yield bonds tend to have shorter durations. They mature in 2 to 3 years. And if you can lock in about a 7-8% yield in the high yield market for such a short time horizon, I think that's an incredibly attractive proposition to wait out the current more uncertain environment.
Does that also mean that you are perhaps taking a view in your investment portfolio of diversifying a bit more away from the US into Asia or Europe potentially?
I'd say we had already started doing that about 1 or 2 years ago, and this trend I think will continue. It definitely makes sense to take advantage of the full breadth and depth of the global fixed income markets rather than just being focused on the US. But again, as I said, the US will probably be the core holding for most fixed income portfolios, just because the opportunity is pretty good there too. US high yield yields about 7%, and many other sectors, securitized mortgages, have outsized yield potential, and the liquidity and the size of that market is really unparalleled. So it's a truly global opportunity, and I think the Asian dynamic dimension is an excellent complement to a global portfolio.
Can you talk us a bit through about what we're seeing on the curve, right? That rate risk on the front end and the back end, those fiscal concerns. What is that going to mean for the foreseeable future?
I think the fiscal risk is much more pertinent for the long end of the curve. And at the front end, there is this other dimension of a slowing economy, a weaker growth dynamic. And I said, maybe we're not jamming on the brakes, but even the US, the economy is stepping on the brakes. There is a moderation in the growth dynamic. That brings in the question of the Fed and whether the Fed will need to cut rates by the end of the year or in the coming year or so. If growth slows more than what they expect, I think the Fed will cut, especially if it's the unemployment rate that's rising and people are losing jobs. And that's why I think the front end of the yield curve still offers some value at levels that are quite attractive, historically speaking, of north of 4%.
Okay, Navin, thank you so much for coming in, sharing the way you're thinking about your investment portfolio, and certainly something we're going to be keeping a close watch on for time to come. Navin Saigal, Head of Fundamental Fixed Income Asia Pacific at BlackRock. Coming up, AmCham Taiwan President Carl Wegner will be joining us exclusively amid Taipei's tariff negotiations with Washington.
Yeah, but ahead of that, we'll be digging deeper into the latest earnings coming out of Alibaba. Shares are down, off lows today, but still substantially down about 5%. They're underwhelming set of numbers coming through out of the big tech company. Plenty more ahead. Right, welcome back. The stock in focus is this one, and quite clearly, and as you can see, the drop that we had going into the open today, and we recovered somewhat. Keep in mind that we're still up, call it 40%, 45% really, if you bake in maybe the dividend as well and some of the stuff in there. But year to date, so it's done well, but it's failed to impress is a question mark. I'm looking at consensus rating here on the stock. That should be coming up on your screens as well. Largely still bullish, north of 4.8, 4.9 on consensus rating here coming out of the sell side. Let's bring in Robert Lee, our senior analyst at Bloomberg Intelligence, to just help us understand what drove the sell-off, and do you buy the disappointment in the market today?
Okay, well, as we say in Bloomberg, context is everything. Yep. So I think we saw the sell-off because obviously sentiment and expectations were pretty high going into the numbers, and the stock has rebounded since we got a short-term relief on the tariffs over the last weekend. So, the stock was trading on a relative near-term high, but what led to the disappointment? I think there are a number of things. First, at its core, Alibaba is still an e-commerce business, isn't it? So. Yeah. Whilst the numbers were broadly in line, in relation to that, their international business was quite weak, or the revenue came in weaker than expected, and no wonder given the tariff uncertainty. So there is a question mark as to the revenue outlook on that AIDC international business, and that, there's a real risk that it's probably likely to be lower than expected. So I think that's one thing. Also, their China, if I can pronounce it properly, logistics business as well came in a bit weaker. On the call last night, they talked about the need to invest in their e-commerce business, which raises the question of margin progression going forward. And as we know, within the China e-commerce market, it's cutthroat competition. It's intensely competitive. There's a lot of subsidies being put forward at the moment, but ultimately, whilst that may drive some volume, and the government is obviously looking to stimulate consumption, there is a question on the margin impact. So all that relates to the e-commerce business. But as you know, probably the last 6 months or so, what has driven sentiment towards Alibaba has been AI. And on that front, their margins disappointed for the fiscal fourth quarter. So I think Alibaba is quite well placed to capture growing demand for cloud services in China. And the revenue growth accelerated to around 18%, rounding upwards. But the margin came in lower because, again, sorry, I'm a bit of a broken record on this. Cutthroat competition.
It's an important point. Yeah,
cutthroat competition. In fact, a rising cloud contribution is actually dilutive to their overall group margins because the margin they generate there is quite low. Shall I carry on? I've got a couple more things to say. Yeah. I think the other thing is, there are bigger questions about shareholder returns and also cash flows because as they prioritise their
buybacks.
As they prioritise on capital spending, obviously in terms of investing in their cloud business, they can't continue to buy back at such a rapid rate. So the level of buybacks that we saw in fiscal Q4 was actually, I think, a 14-quarter low. So again, I think that disappointed some expectations on that front, because obviously, inherently, they're a very cash-generative business with a solid balance sheet. So the prioritization is on capital investment in AI, but then we've got questions as to the sustainability of the margins in that business, given the competition, and ultimately the ROI. So if I take a step back, I think ultimately people are concerned about the future scope for margin progression in this business, whilst maybe the top-line growth in cloud and e-commerce can keep up, due to competition, due to macro headwinds, due to the ongoing uncertainty on the tariff front. I think there's a major question on the margin and ROI. So I think that's a very long-winded answer.
Yeah,
thank you for giving me the time.
No, but that was 6 minutes, and I think you covered everything. Thank you so much, Robert Lee there. Just about on everything, really everything there in Alibaba. Shares are still down. And I think to the points that Robert just brought up there, right? It depends what people thought they were or think they're buying, right? Was it positioning given how underweight global investors were on Alibaba, number one? Are you buying a company that is giving back a lot of money to shareholders? And to what extent can they continue that given, of course, the core business? And are you buying a core business, which is really e-commerce, where you really have a lot of competition there? Or are you buying an AI play, where I think we really have yet to see that play out as far as revenue generation is concerned? Baba down about 5%. Plenty more ahead. This is Bloomberg. Right, welcome back. Jamie Dimon, the boss at JPMorgan, warning of a recession. Well, he says it remains a possibility as the fallout from President Trump's trade war continues. He spoke exclusively with our colleague Francine Lacroix at the JPMorgan's annual Global Markets Conference in Paris.
We have all this uncertainty. Some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so there's a lot of uncertainty still. And there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote or something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. When war in Ukraine, terrorism in the Middle East, Iran, huge deficits, our tax bill, which I would like to see a good tax bill pass. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, partially making up for the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't. And volatility could be good or bad depending on who's facing it. So,
has it begun?
But I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Has it been good for JPMorgan? What's your trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
There we go. That was Jamie Dimon speaking, of course, exclusively with our colleague Francine Lacqua in Paris, and his thoughts really on the possibility still that don't get too complacent, given that we're still looking at a lot of moving parts out there. Right, Hang Seng Index down about 1% here going into the first hour of trade. A couple of other things that we're tracking. We talked about at length already about some of the earnings and Baba and everything else. One other story that's taking place, Xiaomi and supplier shares there are in focus on this plan to unveil a chip. And we're looking at marginal, modest, in some cases, not all, gains going into here. And infrastructure stocks in focus on the back of some maybe policy priorities around urban renewal. Right, good morning. We're going into the Japanese lunch break, and I think we had some GDP numbers out earlier on. Apart from that, it's been very quiet, so I'll just gloss over that for now and let us sort of slide gently into the lunch break. Rates, though, despite us seeing some downside right now, are really the path of least resistance has been all the way up, really, when you look at JGB yields. There we go, GDP print. Thank you so much. Coming in -7. And this, keep in mind, this was before, of course, the tariff conversations muddy the outlook, perhaps even further. Right. Let's talk more about Japan, and really one company that has been under the spotlight, suffice to say, of late is Nissan. Well, the CEO, Ivan Espinosa, says that the car maker must get its own house in order before considering partnerships with other parties and companies. The company announced it is closing factories and cutting 20,000 jobs in this bid, of course, to stem mounting losses as it posted its, oh, this is a very long introduction here, posted its worst financial results in 25 years. He spoke with Sherry Yan, our colleague, of course, about whether those measures were enough.
We're confident that this is enough because the plan, as I said, is robust. It has a leg on the fixed costs, which is what you were talking about, restructuring our manufacturing footprint and work around our overall size in terms of human resource. But not only, it has another very strong leg on the variable cost front. Yeah, on the variable cost front, we also have around 250 billion yen of costs that we will reduce. And we are already working on this. We started a few weeks ago with a team of around 300 experts. And in the few weeks that they started to work, we already have visibility to around 75 billion yen of savings in variable costs. Yeah, and we're accelerating this by putting additional 3,000 dedicated people into this sprint on the variable cost front that will drive a lot of savings. Yeah.
Given the uncertainty and the lack of visibility when it comes to tariffs, of course, how will that impact the overall restructuring effort?
Yeah, well, the manufacturing footprint, the design that we put around is very flexible. So one of the beauties of Nissan is that we are a global company that has a very broad footprint in terms of operations. And taking this into account, the plan that we have laid down has this flexibility to adjust because for the moment is the US, yeah? But the world is moving, you know, by the second. You know? So now we have this problem in the US, but we may encounter, unfortunately, more headwinds in the future. So the manufacturing footprint strategy that we have laid down allows for this flexibility.
Your liabilities will rise to over $5.5 billion by next year. So despite right now where you stand in terms of the capital position of Nissan, you're not necessarily looking at a full-blown merger at this point.
Yeah, we're considering, as I said, the strategy today is to focus on the short-term improvement of a company. Again, the point is not to do a partnership because we need to be partnered with somebody because of a cash position. The cash that we have on hand is enough to go for the next 12, 18 months without doing anything.
That was Sherry's interview, of course, with the Nissan CEO on really the steps that they need to take, and it's obviously a very big challenge that the company faces, and certainly several steps before they can then address some of the core issues there. Fantastic conversation there with Sherry, with the Nissan boss. Now, speaking of navigating a complex issue, you have a lot business leaders are looking to navigate certainly tariff uncertainties. You have Washington, of course, engaging in preliminary talks, in some cases advanced talks, with a number of their trading partners, including Taiwan. Now, Taiwan's vice premier says that more discussions are expected. That's after initial negotiations, of course, earlier. Now, just this morning, I think if you joined us earlier on the shows, we did show you some live pictures out of Taiwan's parliament. You had protesters gathered there to voice their opposition against the government's plans to implement a zero tariff policy on American products. Now, separately, you did have, of course, Donald Trump's unification comments causing some concern. And, of course, the reference there was really more on a trade negotiation with mainland China. You had the presidential office in Taiwan, for its part, saying that to our understanding, Taiwan-related issues were not touched upon during the U.S. and China trade talks. Joining us exclusively now is Carl Wegner, AmCham Taiwan's new president. He took up the role just a few days ago. So, Carl, good morning, and we appreciate you taking the time so early into your new gig. So tell us, how's it been so far?
It's been fantastic, and thanks for the opportunity. Yeah, it's only my second week, so stepping into this new role, but Taiwan is not new to me, or the role is not new to me. I've been lived in Taiwan for over 20 years, so it's nice to be back and nice to see how I can support the community.
What are your priorities, given, as you point out, it's a very complex and nuanced environment right now?
I mean, really, the priority for me is to continue to help AmCham. I mean, to give a little bit of background, AmCham Taiwan is the largest foreign chamber in Taiwan. We have over 500 members. About a little over half of those are American. The rest are Taiwanese and international. And we have 25 committees working with different industries to look at, what policies may be challenging for new businesses, where we can collaborate more. So we have a pretty good pulse on what what our members want, what our members are looking to. And to get to your question, my focus is really to continue to help AmCham. Great team here, but to help them be the bridge, that vital bridge between the business community and policymakers. So again, just continue what we're doing. And again, the AmCham's a lot bigger than it has been in the past, and it's becoming more and more important, I think.
And what's if you could maybe, if there is one common denominator as far as common ask, what is the ask among members that, to your point, you are the bridge that you could then convey to policymakers? What's the number one number one on the wish list?
I think the number one on the wish list that's been around for a little while is looking at dual taxation. There is no tax treaty between the U.S. and Taiwan, and so that's they feel it's sort of a good opportunity, not too hard to build, and that would encourage more investment and building on both sides.
Right. Now, Carl, I need to ask about if you're getting any sense with the people you talk to or your members specifically on where you guys think the current state of trade negotiations are currently. I wonder if you have any insight on that.
No, we don't really have any insight on the trade negotiations. I think we've heard that, again, they're continuing. Obviously, we're looking for the most cooperation we can between Taiwan and the U.S. and we're hoping that we come to, with the tariff issues, we come to a period of stability so people can decide to invest more. But we see it as hopeful. We still have until early July to come with a solution.
The other big story over the last 2 weeks or so has been the move in the currency, and it's hard to ignore that and how that really affects some of your members who, of course, do business cross-border. Carl, what's the conversation like around the Taiwan dollar? And is there a general expectation that we've seen most of the strength? Are people prepared for more strength to come through in the Taiwan dollar?
That's a great question. We've been trying to keep up on the changes. We did a business climate survey that at the end of last year. We did one on tariffs that just came out a few weeks ago and talking about tariffs and implication. We really haven't done anything on the change in the currency. It's a little bit too recent. So, and I haven't had a chance to talk to enough members yet to have some insight into that. But, yeah, obviously it's a big change, and we'll have to see how it plays out.
Yeah, absolutely. Carl, in fact, just to mention that, and almost as the news gods would have, as fate would have it, we are just hearing right now from the Vice Premier talking to reporters, and maybe just to give you some context here, he is reiterating that trade talks with the U.S. do not involve perhaps an agreement or negotiations around the exchange rate for now. So I guess to the point you're making, we'll see where the dust settles on this, given how far it's come and how expensive hedging costs have been for the Taiwan dollar. Well, talk to us then about what remains agnostic, if you will, to the trade conversations. What's doing well? What's business as usual?
I mean, again, if we look at the business survey and talking to our members, I mean, overall it's positive, right? We had the business survey, and 80% of our members are looking to increase their investment or business in Taiwan. They have positive outlook for, I think 70-some% have positive outlook for the next 3 years. So Taiwan is, they see a great opportunity in Taiwan. The collaboration and that synchronization between the U.S. is obviously very important, especially on, some of these sectors, semiconductors and others. So it's quite positive. Even the tariff issue, when we did the tariff survey a few weeks ago, only about half of them said that they were going to, they were a little bit more worried, and they might pause some investment, but or just put it on hold for a bit. But overall it's positive. They're looking for the opportunities in technology in Taiwan as a very unique partner of the U.S. to work together.
Carl, fantastic to have you. Thank you so much for taking the time in your first few weeks there in your position. But as you point out, of course, you've been around the block as it pertains to the Taiwan story. AmCham Taiwan President Carl Wegner there in Taipei for us. Plenty more ahead here on the China Show. Markets to my right on offer a little bit as we go into the weekend.
Minister Lee, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
There we go. The brief exchange. That was the Chinese Vice Commerce Minister Li Chenggang speaking to our team at the APEC Trade Ministers meeting taking place in South Korea. Now, that takes us into really what's making headlines in local Chinese media as it pertains to still this ongoing story of trade negotiations. A Global Times editorial is highlighting that the U.S. and China trade ties via the high demand being seen in the shipping market. Now, the piece says Shenzhen's Yantian port is operating at full capacity. Cargo bookings to the U.S. have also skyrocketed, with almost all routes to the U.S. fully booked for this month. Now, another opinion piece, this is from the Global Times as well, has bashed the U.S. blacklist on some Chinese firms. Earlier this week, you had some Republican lawmakers calling for a ban on China-linked router maker TP-Link. That's over some security concerns. Now, the report then accuses some U.S. politicians of being opportunistic, while pointing out that TP-Link is an American firm which makes most of its U.S.-bound products out of Vietnam. Right. Staying on theme, the WTO Director General says any decoupling of the U.S. and China would create a negative spillover effect that could actually hit the poorest countries the hardest. She spoke with us from the sidelines of the APEC meeting in South Korea about the mood among delegates.
I would say that the tone has been very constructive. I mean, everybody is obviously quite worried about the global trade environment, and that's understandable, but very constructive tone, a willingness to look at what should we do and what are the solutions.
What is the feeling from your standpoint, too, about the truce that was sort of struck in Geneva over the weekend, where we basically knocked 115% down on tariffs for the U.S. and China? That sets a better tone. Are you encouraged or still concerned about global growth going forward and global trade?
I'm very encouraged, to be honest, because we had felt that any decoupling of China-US or breakdown in their trading relationship would have quite negative spillovers on the rest of the world, but especially on poor countries, especially if trade really fragments into two trading blocks. So the fact that there's been a de-escalation, an agreement to reduce tariffs to the extent they have, I think is a good sign. We've actually started to model what the 30% for China and the 10% for the US that China has put in would mean. And it's really helpful that it shows, instead of a 0.2% contraction of global trade, when we layer that in, it turns around to a 0.1% growth. You know, so it's a turnaround, not as large as we would wish, but it's a better sign. So I think that, you know, if we can make further progress during the 90-day pause, that's even better.
You think there was progress today? We just heard Li Cheung, who's the Vice Commerce Minister, who had those talks with Jameson Greer. He said they had good talks, they had long talks. Does this build on the momentum that they got in Geneva?
Well, I'm not privy to the talks that were held here today, but whatever engagement they have, what we know is that they've set a framework for engagement. So that gives the additional space for them to meet wherever and whenever they can to try and advance. What is good for us is, one, the platform they've set is a good one. It's better than we expected in the beginning. And then the idea that there'll be further progress during the 90 days, I think, is welcome.
How concerned are you, though, through this trade war that the Trump administration has essentially launched, as well as, of course, global tariffs? He's paused it for sure, but how concerned are you that the multilateral approach is being, undermined by a not only unilateral from Donald Trump, but bilateral trade agreements that are being lined up?
Look, I mean, there have always been bilateral FTAs with the WTO alongside. There have been regional trade agreements. So that's not the issue. The issue is consistency with the WTO framework. And that's what we've been urging, that whatever agreements you enter into, that's what I said at the APEC meeting, should be as WTO consistent as you can make it.
I also know, the WTO had an outlook, I believe, in April about merchandise trade going to go into a deficit this year because of the uncertainty. Does the truce, the 90-day, and if it goes on beyond that, does that change your outlook for global growth this year?
It makes it slightly better. The fact that this truce with the 30% tariffs that the U.S. is going to levy on China and the 10% China will levy on the U.S. brings down substantially the number of tariffs so that it makes a difference in our outlook. And it goes from a 0.2% contraction of global goods trade now to a 0.1% growth. But remember, this is still compared to 2.7% growth that we had projected pre-tariffs. So we're not where we would like to be, but we're better with this agreement between USA and China.
Right, that was the WTO Director General there speaking, of course, with our Chief North Asia correspondent, Stephen Engled, at the APEC meetings in South Korea. Turning to some other major stories we're tracking now, you have shares of Coinbase down, and the big story there certainly down about 7% in New York. So double whammy there for the company. This hacking and also the SEC probe. The largest U.S. crypto exchange said hackers bribed its foreign employees to steal customer data and then demanded a $20 million ransom, which the company then refused to pay. The breach may cost as much as $400 million to remedy. Meanwhile, on the separate but related story here, the Coinbase also said it is cooperating with an SEC probe into whether it misstated user numbers. Now, shares of Applied Materials fell sharply in extended trade. That's after the company gave a lackluster forecast. The largest American maker of chip-making equipment expects sales of about $7.2 billion for the current period, which is lower than analyst estimates. Now, the company is adjusting to restrictions on sales to China, which is one of its biggest markets. All right, this is one of our most read stories right now. Michael Burry and, of course, his Scion Asset Management has liquidated almost its entire equity portfolio in the first quarter. Now, Burry also bought put options on NVIDIA and wagered against the likes of Alibaba, Baidu, JD.com, and PDD, which were his top holdings in previous quarters. Now, the portfolio shift came as Chinese companies rallied at the start of the year, driven by DeepSeek's AI breakthrough in AI before Trump's tariff wars. Yep, and in case that wasn't clear, that was according to a filing, of course, that's coming out of the company. Right, you can turn your attention to TV Go for our Bloomberg clients in case you missed any segments, interviews, and reports that we've done in the last few hours or so. It's generally been a quiet session so far. We'll, in fact, underscore that point with an update of markets on the other side of this break. You're watching The China Show. Welcome back. Here are some big corporate stories we're following this Friday morning in the Asia Pacific. We're looking at shares of NetEase up and up, as you can see, substantially. Nice day at the office here after the Chinese firm reported sales and earnings that actually beat estimates. Now, revenue for the first quarter coming in at $4 billion. That's boosted by its core gaming business. Now, NetEase's quarterly gross profit was just under $2.6 billion, beating street estimates. Now, we're looking at shares of Geely as well, coming up on your screens. Also in focus here, that's after the company reporting first quarter net income that arrived at the high end of the prelim results range. Net income was $786 million, with revenue up 25% on year, coming in at $10 billion. Meanwhile, you have the company saying that Zeekr CEO Andy An will become the group CEO. That's after this privatization. After Zeekr's privatization here by Geely Auto, that transaction is complete. Right, ByteDance is targeting revenue. This one actually just coming in this hour, I believe here. A growth of about 20% in 2025. That's despite a potential global economic downturn if achieved. Now, the pace of expansion could help the company match Meta's global business. Now, sources say TikTok's owner expects sales to increase to roughly, get this, $186 billion from the $155 billion in 2024. Massive. Now, that is slightly below Meta's projected revenue of about $187 million. Now, speaking of Meta, shares dropped after reports that the company was delaying the rollout of its flagship AI model. The Wall Street Journal reported Meta engineers are having trouble improving the capabilities of the large language model known as Behemoth. Now, the paper talks about the release as now being postponed to late 2025. All right, so we talked about NetEase and Geely there, and of course the other big story is Alibaba, and that one coming in at 5.3% to the downside right now on shares there. Coming off lows of the day, but that was, I think, in context, the disappointment coming through from the markets, but it's worth pointing out, shares are still up north of, I believe, north of 50% still here to date. So maybe there is the temptation to take some money off the table, given the, let's put it, lack of blockbuster aspects to the earnings report that came out. Right, the setup going into the rest of the session today across the world, this you have U.S., European, and India futures coming like this. There we go. You know what? There's really not much happening across this as well. It's worth pointing out that when you look at volumes, to underscore that very point, I'll just tell you this, that there's about 30%, we're 30% lighter than usual for this time of the day. I'll leave you with a good note, though. We are about 1.5% away from an all-time high on global equity markets.